Hi, my name is Kie'Shary Morrison, and for my analysis report, we'll be discussing Steelcase. Steelcase Incorporated, headquartered in Grand Rapids, Michigan, was founded on March 16, 1912. Today, Steelcase is known as the world's leading manufacturer of furniture settings with over 105 years of insight gained serving the world's leading organizations. While the company's brand focuses on office environments, it also offers services which include workplace strategy consulting, leasing origination services, furniture and asset management, and hosted spaces. Their innovative legacy began in 1914 after receiving their first patent for the manufacturing of a fireproof metal wastebasket for office settings. This led to their commitment to unlock human promise through innovative ideas that help improve the workplace and the world. Companies in this industry manufacture household, office, and institutional furniture and related products, including mattresses. Major product categories include household furniture, office furniture, mattresses, shades, and blinds, custom architectural woodwork and millwork, and institutional furniture. The volume of office furniture sales in this industry are contingent on the health of the U.S. economy. Demand for office and business furniture and fixtures is driven by corporate spending and commercial construction and vacancy rates. Costs are often fixed. Therefore, profitability is determined by volume of sales. The industry is anticipated to benefit from the increasing number of U.S. businesses, which is a core segment of the industry's customer base. Steelcase has quite a few competitors in the manufacturing industry. Three of their top competitors are H&I Corporation, Herman Miller Incorporation, and Haworth Incorporation. H&I Corporation specializes in making office furniture, including seating, storage, modular workplaces, and desks. Founded in 1944, H&I has distribution partners in 50-plus countries, but most of its products are sold in North America. Herman Miller Incorporated is a top U.S. maker of office furniture. In fact, the U.S. government is Herman Miller's top customer. Their products are manufactured in the U.S., UK, and China and are sold all across the world through its sales staff and dealer network, as well as through independent dealers and online. Finally, Haworth, another top U.S. maker of office furniture, is family-owned by Gerard W. Haworth, founded in 1948. Operating in more than 80 showrooms worldwide, Haworth uses a dealer network to sell its products in more than 120 countries. For most of my analysis, we will discuss Steelcase's financial performance compared to its competitor, Herman Miller. Currently, Steelcase employs over 11,000 employees, globally integrated. Steelcase refers to them as their greatest asset, who showcase a strong commitment to integrity and doing the right thing for their customers, employees, business partners, associates, and neighbors. Steelcase offers their employees many benefits for their contribution to their renowned success. These benefits include pension and welfare benefits, health coverage, life insurance, employer financed and retirement plans also. Net sales over the last 4 years for Steelcase have been pretty consistent. Their net sales for 2018 are $3.1 billion compared to its competitor Herman Miller, who ended fiscal year 2018 with $2.3 billion in net sales. Compared to its top competitor Herman Miller, Steelcase appears to have the most success as it relates to sales. For 2018, Steelcase spent $813.2 million and administrative, selling, and general expenses. This is a 10% increase since 2015. On the other hand, Herman Miller spent $616.7 million in 2018. This is a 13% increase from their expenses in 2015. For Steelcase, their expenses are likely to decrease over the next couple years. According to their corporate sustainability report for 2017, they had begun to make progress in energy use reduction and managing their assets by reusing and recycling workstations. Steelcase's gross margin is about 32% of their revenue for 2018, which is about 32 cents of every dollar paid toward expenses, which is a steady increase from the years prior, as seen in the chart. Compared to their competitor, Herman Miller, who had $873 billion in gross profit for 2018, which is a 36% of their revenue for 2018, which means Herman Miller has paid 36 cents of every dollar in revenue to cover their expenses this year. Net income is the source of compensation to shareholders or owners of the company. And if a company cannot generate enough profit to compensate owners for the risks they have taken, the value of the owner's shares will plummet. Although it does not indicate cash flow, it does indicate successful use of invested or borrowed funds. Steelcase's net profit for 2018 was $80.7 million, which is a large decrease from 2017, which totaled $124.6 million. The inconsistency in net profit may have resulted from variances in their expenses. Herman Miller's net profit came to $128.1 million for 2018, which is an increase from $97.5 million in 2015. It is fair to say that Herman Miller has experienced a steady increase in net profit over the last few years. Operating margin is important for analyzing operating income and operating expenses. The higher the operating margin is, the more profitable the firm is. Steelcase's operating margin has declined over the last 3 years. This means that Steelcase's core business has been experiencing a decline in profitability. For 2018, their operating margin fell to 5.2% from 6.7% in 2017. Their competitor, Herman Miller, has also experienced a decline in operating margin. However, their operating margin is still a bit higher than Steelcase's. For 2018, Herman Miller's operating margin is 7.6%, a significant decline from 8.9% in 2017. Before that, Herman Miller's operating margin was 9.3% in 2016. The profitability ratios allow us to measure the ability of the firm to earn an adequate return on sales, total assets, and invested capital. Return on assets show whether a company is efficiently using their assets from the balance sheet. A high turnover ratio indicates higher profitability. In 2018, Steelcase generated 4 cents per every dollar of assets, which I found was a decline from all years prior. A rapid decline in return on assets indicates that Steelcase is not quite efficient using their assets, which means that Steelcase must sell their assets in large volumes to earn a profit. Their competitor, Herman Miller, generated 8 cents per every dollar of their assets in 2018, which was also a decline from the years prior. Equally important to a firm is its return on equity or ownership equity. Return on equity ratio indicates how amply owners or shareholders of the company are rewarded. Over the past few years, Steelcase has experienced a substantial decrease in return on equity. For 2018, their return on equity decreased to nearly 10% from 16% in 2017. Herman Miller also experienced a decline in their return on equity over the last few years. For 2018, return on equity decreased to 19% when it had been 21% the year prior. But compared to Steelcase, Herman Miller was better rewarded over the past 3 years. The second category of ratios relates to asset utilization, and the ratios in this category may explain why one firm can turn over its assets more rapidly than another. One asset ratio is known as the inventory turnover ratio. This helps us determine what a company generates in sales per dollar of inventory. Over the last few years, Steelcase's inventory turnover has declined. For 2018, their turnover ratio is 16.5, which is a decrease of 2.6 over the past 3 years. Their decline in ratios indicate that the firm has not been as efficient in ordering inventory and cost control methods, or they possibly lost some of their consumers to their competitors. On the other hand, their top competitor, Herman Miller, has been consistent in their inventory turnover for the past 2 years. For 2018, Herman Miller's turnover ratio is 14.6 compared to 14.9 in 2017. All in all, both companies appear to be generating sales per dollar of inventory. A minor consideration in view of the rapid movement of inventory and accounts receivable is the ratio of sales to fixed assets. Steelcase's fixed asset turnover ratio is 7.02 for 2018, whereas Herman Miller's fixed asset turnover for 2018 was 7.18. Steelcase has a slightly lower ratio of sales to fixed assets than does Herman Miller, which indicates that they have not invested as much in fixed assets as their counterpart. After considering profitability and asset utilization, the analyst needs to examine the liquidity of the firm. These ratios help determine whether a firm can pay off maturing debt as it comes due. For 2018, the current ratio for Steelcase is 1.53 times. This is a decline from the year prior. Herman Miller's current ratio is slightly higher with 1.55 for 2018. In comparison, Herman Miller's current ratio is higher than Steelcase's, but overall they both appear to be doing well. Steelcase's quick ratio for 2018 is 1.20 times. This means that Steelcase's assets are 1.20 times their liabilities. For 2018, Herman Miller's quick ratio is 1.16 times, which is a fair well in comparison with its competitor Steelcase. The last grouping of ratios, debt utilization, allows the analyst to measure the prudence of the debt management policies of the firm. A general key for analyzing debt ratios is the more debt a company has as a percentage of assets, the less healthy it is financially. The ratio of total debt and total assets should fall well within the prudent range of 50% or less. The higher the ratio, the greater the risk associated with the firm's operation. For 2018, Steelcase's debt to total assets ratio was 56.2%, which is slightly above the prudent range of 50% or less. However, it has decreased over the last few years. Herman Miller finished the end of fiscal year 2018 at 53% in debt to total assets. Theirs has been consistent over the last few years. The debt-to-equity ratio is a financial ratio indicating the relative proportion of shareholders' equity in debt used to finance a company's assets. For 2018, Steelcase's debt-to-equity ratio was 1.28. Compared to Herman Miller, Steelcase's debt-to-equity ratio is low. Herman Miller's debt-to-equity ratio was 3.25. Compared to its competitor, Herman Miller, Steelcase falls below industry average in the following areas. That is operating expenses, net profit, liquidity, and debt utilization. However, they still had a solidly profitable year with an industry-leading $3.1 billion in revenue and net income of $80.7 million or 68 cents per share. In a fast-paced world and a competitive industry, Steelcase must stay ahead of trends and continue to incorporate technology in their operations and product development. Doing this, they saw an increase in operational expenses, but it is anticipated to pay off fiscal year end 2019. I would recommend Steelcase finds a way to generate revenue without putting themselves in debt, which would help improve the company in terms of profitability. I would also suggest less money be invested in new product development and perhaps focus on enhancing existing products in order to minimize costs. This is the conclusion of my presentation. I hope you enjoyed my analysis of Steelcase, and thank you so much for listening.